Hi there, class. This is a extra session that I thought some of you, or maybe all of you, would want to watch and try to get that much farther up the learning curve on some of the materials that we covered in Class 2 and some of the topics that are addressed by the homework that's due for Class 3. So I kind of call this Class 2 Extra, if you will. So what I'm going to do in this recording is, I think, two things. One is, I think I'll go through one of the homework problems for Class 2. And we don't typically go through the homework in the following class. I'll hand out the solutions, but like I said, we typically won't go through it. So I'm going to use, since I'm using this video technology, why don't I spend the time to go through one of the problems the way I would do it. And that'll give you a sense of, if I was going through the homework, what it would look like. Okay, so I'll just do one of them. In the handout that we sent, there were 3 problems. The 3 are pretty similar. The facts are different, but the level of complexity is roughly the same, and the concepts covered are also similar. So I'll go through one, and my hope is that that will help you with the other 2 as well. So we'll spend a little time doing that, and then the second thing is one of the topics that we touched on very briefly in Class 2, and that you'll see is relevant in the homework that's due for Class 3, and this is also covered in Class 3 some, is Fed benefit of state. Okay? And what I mean by that is, remember in Class 2 I said that anytime you pay $1 of state tax, you get a federal deduction. And so that means whenever you're quantifying the provision effect of a state tax dollar, you need to think about it as being net of the federal effect, or 65% of your state tax will really ultimately end up being your total tax expense between state and federal when you think about it. Okay, so this can be very confusing. We touched on it briefly in class, but you know, there are both current provision implications here. Oops. As well as deferred. And I find that people can process the current piece pretty easily, but this deferred piece right here, boy, that gets really people confused. So I'm going to go through some simple examples of that in this session, and then let's just see if that helps in your understanding of what we cover in Class 3. Okay, so let's start with the homework for class that's due in Class 3. It was handed out in Class 2. And this is the homework assignment I thought I would go through. It's the one labeled QWE Corporation. Okay? So let's just go through the facts together briefly. Oops. Okay, so the facts are that we have book income of $3,500. There's no tax expense. And so $3,500, although it's labeled as book income, is also our pre-tax income. We had meals and entertainment expenses of $750. Tax depreciation which exceeded book by $1,050. So we have greater tax depreciation. There is deferred revenue of $630. So that means that we received revenue from a customer. Books decided to defer it, meaning not recognize it as income on the financial statements. But for tax purposes, that cannot be deferred, meaning when we received the cash, we had to recognize the revenue immediately. Okay, and let's I know we can get into a debate as to whether that's right for tax purposes, but in some cases that's correct, and let's just assume that's right for our example. We had a, I hope this doesn't keep popping up. We had an increase in prepaid insurance of $450 during the year, and finally we had interest income of $275 from municipal bonds. Okay, so our questions are pretty similar. It's, you know, what are our perms, what are our temps, and, you know, in a sense, the rest of the question is, how do you do the provision? So let me, rather than trying to slip that into those brackets, let me just start writing on a blank sheet of paper how I would calculate this. Okay. So I'm going to go through the kind of typical step 1, step 2, step 3 calculation. And so let's start that with PBT. We have PBT of, what did we say, 3,500, right? Oops, I already got that wrong. Okay, so we've got our PBT of 3,500. Okay, so then let me go through my perms. And my perms are, let's see, I had 750 of meals and entertainment expense. And so that means I need to add back half of that. So that will be an add back of 375 for M&E. And then for interest, I had 275 of municipal interest income that will never be taxable, right? Oops. So now I have my temps. So recall that I had depreciation of 1,050, which for tax purposes I was going to have bigger tax depreciation this year than books. And so that means in the future it'll flip, right? But for now I have tax depreciation, which is bigger than books by 1,050. I have deferred revenue. And deferred revenue was $630, if I remember right. So what that represents is income that for book purposes, there's no deferred revenue in here, right? No deferred revenue, because the revenue is going to be recognized next year for book purposes. So that means if I have to pick it up as taxable income this year, it's an add back. And the third temporary difference that I had was prepaid insurance. Prepaid. And that balance increased by $450. Okay? And that's a deduction because, like we discussed in our last class, as I pay that, I get a deduction even though for book purposes they haven't expensed it yet. Okay? I think that was all our differences. So if I sum that up, boy, let me do the math really quick. Okay, so I have $2,730 of taxable income, right? That's what it would look like on the face of my tax return. And my tax rate is assumed to be 40%. And so the tax on that is 1092. Okay? So that is my current liability. Right? So if I was thinking of my journal entry, I'm going to, let's see, I'm going to do that over here. I'm going to credit my payable by 1092. Okay? So that's step one. Step two would then be to look at my deferreds and say, well, what's the sum of those guys? There's three moving temporary items. So the sum of those, let's see, 1,500 minus 630 is going to be 870, right? 870 is my net deduction from temporary items. And so if I take that times 40%, what's that going to be? That's going to be 348, right? So that means I would expect that if I took a deduction this year of 870 that exceeded books, that in the future I'll have the opposite 870 effect. So that 348, that will be a deferred tax liability. So I'm going to credit DTL for 348. Okay. And if I balance my entry, right, I have my step 1. Okay, that's step 1. And I have step 2. So I've got 1092 and 348. That would mean that in order to balance my entry, I would have a debit to provision of 1440, right? And that is step 3. Okay? So that is my total provision. And I think it would be good practice for you to get in the habit of the rate reconciliation that we talked about last time. So if we did that rate reconciliation, let's do that together. Remember that I started with PBT of 3,500, and at a 40% rate, that means I would have expected a provision of 1,400, right? Oops, it's hard to see. Okay, so if I would have expected a provision of 1,400, and I ended up with a provision of 1,440, I need to explain my difference, right? And my difference should be my perm differences, right? So I have meals and entertainment of 375 times 40%. And let's see, how much is that going to be? That's going to be 120, 148. So that should be 150 if I did that right. And then the tax-exempt interest, let's see, our tax-exempt interest is going to be our second perm, and that was a good guy of 275, meaning that was a favorable permanent difference of 40%, and so 40% times 250 is going to be 110. And so our rate rec works. Okay, so we have a total provision of $1,440. Okay? All right, so I know that's kind of messy, but man, I cannot make my handwriting better on this tablet. In any event, our total provision is $1,440. And that's how I would have done it. Okay, so hopefully that's a the solution might look a little different from that, because I think the way the solution works is it takes the journal entries for current and breaks that out into a current expense, and then it separately shows the deferred movement with deferred expense, and then if you sum those two expense items up, you get step 3. So the presentation is slightly different, but it's really that all I've done in this markup is shown it as a net provision as opposed to current and expense on a gross basis. I think that's how the solutions for the most part work throughout the course. But I think, at least for the purpose of being brief here, you can see step 1, 2, and 3 all at once. Okay, so that was the first part of what I said that I would cover in class here, or this extra lecture. So that's homework from class 2. So let's do Fed benefit estates. Okay, and you'll find that, like I was saying, this can be a little tricky. Just give me a second to get organized. All right, so let's start very basic. Okay, let me get my pen working here. Let's assume in our facts that we have, let's assume that our facts are, we have PBT of 1,000, and we have a federal rate. Let's say our federal rate is 35%, and our state rate is 10%. Let's make the math as easy as we can possibly make it. Okay? And let me make copies of these assumptions because we're going to work off of this in the future here. Okay. So we're back to this page. We have PBT of 1,000, Fed rate of 35%, state rate of 10%. Okay. So then what I'm going to do is I'm going to break the page into roughly 3 sections. Okay. So first, remember I said we should calculate our provision jurisdiction by jurisdiction, and notwithstanding that both the federal and state returns are U.S. returns, they're really separate jurisdictions. So I'm going to, oh boy. Okay, let's go with that click. Okay, so I'm going to start with state. Okay. So if I was doing my provision for state, this is very easy, right? My current liability is going to be 1,000 times 10%, or $100. And then I would say my deferred liability, my step 2, is 0, right? I don't have any temp differences. So my provision is 100, right? And if I was creating a journal entry after that, I would credit my payable 100, and I would debit my expense for 100. Okay? So let's say that I'm going to move on and do my federal provision now. Okay? So if I was doing my current for federal, well, then let's say that I would have a current deduction for this 100 of state tax. Okay? So I'm going to take this current of 100 and bake that in. I'm just going to kind of do a dashed line. I'm going to bake that into the calculation of my current liability for federal. So for federal purposes, I'm going to have a current liability which is based off of starting with 1,000 of PBT, but I get a deduction of 100 for state taxes. So my taxable income is 900, and my tax rate is 35%. So my tax liability is 315. Okay, and so if I was doing this in journal entry form, I would credit my tax liability of 315. Okay, my deferreds. Do I have any deferreds? No, I have no deferreds. Okay, there's no temporary items. And so my provision would equal 315. Right? Alright, so now, if I was doing my total provision, I would take my federal provision of 315 and my state provision of 100, and I would have a total provision of 415, right, for an effective tax rate of 41.5%, right? And if I was doing a rate reconciliation, I would say that I would start with PBT of 1,000, and I would have expected at a 35% rate a provision of 350. But I ended up with 415. And that difference is really my state tax, right? So incremental to my 350 of provision I would have expected, I paid 100 of state tax, right? So when I look at my state tax over here, this provision, right there, that becomes this guy. But the thing that I haven't taken into account yet is, from a federal perspective, I have this perm, right? So I'm going to put in my Fed benefit of state, and that federal benefit of state is going to be the 35% of the 100. So that's going to be a 35 good guy, and that's what gets me to my total state, or total provision rather, of 415. Okay, so I want you thinking, I got to do the provision jurisdiction by jurisdiction, but when I get to federal, the state does have an effect on federal, so I need to bake that in. And where things get really confusing is when you add up your total provision, how to do your rate reconciliation to explain that state tax effect as net of the federal impact. Okay, so that's basic. So let's now complicate that just a little bit, and we can start with our same facts, but let's add one more fact to it. Okay, so let's add the let's add meals and entertainment for 100. Okay, and let's do the provision again and show what the effect is. Okay, and I know we're going through this a little slowly, but my hope is that this will help. Okay, so I think again what I'll do is I'll break the provision into 3 sections. Hopefully that format made sense to folks. And we will do a federal, oops, no, we're going to do state first. Much easier to do state first. Okay, so let's do state first, and then we'll do federal, and then we'll worry about total. Okay, so if I was doing my current provision, I would have a 1,000 starting point, and let's say that the 100 is the add back. Rather than, I'm going to make the math as easy on myself as I can. Let's say that the 100 is the add back. So I would take 1,000 of PBT plus 100. So that's 1,100 of taxable income, and my rate is 10%. Right? So that's $110, and that would be a credit if I was doing journal entries. My deferreds are 0. I have no change in deferreds. So my provision from a state perspective is 110. It's 10 higher than it was before. Okay? Let me get out my calculator because I'm guessing that we might need it. Alright, so from a federal perspective then, we're going to calculate our current, and we'll start with our 1,000 of book income. We're going to add the $100 of meals and entertainment, subtract the $110 of our federal deduction for state taxes, and that is going to get us $990 of income. Right? And $999 of income at a 35% rate. So that's 35%. That's going to be 346. Okay? That will be a credit. From a deferred perspective, we have nothing. And therefore, from a provision perspective, we have 346. Alright, total. So my total federal provision is 346. My state provision is 110, which means my total provision is 456. Okay, and that's total. So my tax rate's going up, right? I've got a 45.6% tax rate. That's high. Alright, so if I wanted to explain that tax rate, I'm going to start with PBT of 1,000 and a tax rate of 35%, so that would be 350. But I ended up with a rate of 45.6, and that's a 456 provision, right? So gosh, I got to figure out how did I bridge that gap, right? So I'm going to start with my state tax, and my state tax is going to be this guy. So my state tax is going to be that 110, right? It's the provision I calculated from a state jurisdiction only. Now, from a Fed benefit estate, if I was going to pay $110 of tax, maybe not currently, I know what's current in this example, but if my provision was 110, that means that the tax I'm going to pay currently, in the future because of deferreds, or in the future because of uncertain tax positions, if 110 is the total state tax I'm going to pay, I'm going to get a deduction for 110 eventually. So I know that my federal benefit of 110 is going to be 35% of that eventually. So that's going to be 38 and a half, right? So we're going to have some rounding errors here, but that's okay. And that's going to be a good guy, right? So for that 110, I'm going to always save 38 of tax. And so you can think of that 110 as net of federal effect, and the 110 minus the 38 would be 72, or 72 and a half, or 71 and a half rather. Okay, so then the other piece of the rate rec puzzle that we're missing is we did add a perm. Remember, we added meals and entertainment, right? So if I put in our new assumption around meals and entertainment, then that added $100 to my federal taxable income. That was 100, and at a 35% rate, that would increase my tax by 35. So if I add those up, I should get 456. And again, I think we're off $1 just because of rounding, but you get the idea. So what I want you to take away from that is that the federal effective state tax, boy, it starts to get a little more complicated when we throw in some permanent differences, right? But it's nothing more than really taking the provision I've calculated for state purposes and then applying a federal effect to it. And when you start getting lost in the numbers, you can prove it back by going more slowly. But the rate rec ought to tell you that you've gotten it correct. Okay. All right. So then let's go on to a third example. Let's just make it slightly harder, and then this will probably be enough. Okay, so in our last example, we added meals and entertainment of 100. And then let's add one more. Now let's add a temporary difference. Okay, and let's say that this is bad debt. And let's use a different number just so we don't get confused. Let's say that that's an add back of $200. Okay, so I have a sense that I might need to break this into 2 pages, so let me create a second page here. Alright, I'll try to fit it into 1 page and we'll see how it goes. Alright, so then let's do our same 3 jurisdiction approach. And I'm going to give myself more room for federal, I think. Okay, so we're going to start with state. Then we're going to do federal. And then total. Alright, so if I was calculating my current provision, I would start with 1,000 of PBT. Add back the 100 of M&E, and then add back the 200 of bad debt reserve. So that is $1,300 times 10%, or 130 of state tax. And that is a credit if I was booking a journal entry. Okay, so my deferred items, this time I have a deferred. Right, I have in the blue a 200 bad debt reserve, and that's going to create a future tax deduction. So if I take that times 10%, that will give me a 20 deferred, and I would book a debit for a deferred tax asset. And so my provision is the balancing entry of 110. Okay? And that was the same provision we had last time, and that makes sense because the only fact that we've changed is to add a temporary difference of 200 for bad debts. And by now you've learned that the temporary differences shouldn't, in most cases, affect your provision, and in this case it doesn't. Okay, so now here's where things get complicated. All right, I'm going to go a little more slowly. Now I'm going to do my federal provision. So I have my 1,000 of PBT. I'm going to add the 100 for M&E, the 200 for bad debts, and then I'm going to subtract the $130 of state tax that I pay. All right, so I have 1,000 of pre-tax income plus my perms and temps, plus my perm of 100, my temp of 200 for bad debts, and then I'm going to subtract my $130 of state taxes that I get a federal deduction for, and that's going to give me taxable income of $1,170, and I'm going to apply a tax rate of 35% to that. If I take that times 30%, that gets me 409.5. So I'm going to use exact numbers here so we don't get messed up with rounding. Okay? So that would be my current federal provision. Now, from a deferred perspective, this is where the rubber meets the road. Okay? What I mean by that is we're going to have two deferreds. We are going to have bad debts. Okay, bad debt. And I think you're going to get this one quickly. Right, that is a $200 future deduction. Now, we have Fed benefit of states. Okay, so we've got, get a marker out here. We've got a $20 state DTA. Okay, so what that represents is in the future, you're going to save $20 of tax. Okay? And let's think of this as the opposite just for a second. Okay, so in your mind, hit pause on the example. And let's assume, and maybe I should have done it a slightly different way, let's assume that that state 20 right there was a deferred liability. Let's say it's depreciation. And in the future, I'm going to have a gain when I sell this asset because I've already depreciated it for tax purposes heavily, and books hasn't. So when I sell the asset, I might have a small book gain, but I'll have a large tax gain, and so I have a future tax. If I had a future tax for state tax purposes, that would mean I get a future deduction for federal purposes, right? So if I'm anticipating when I do my state tax provision that I'm going to owe tax in the future and have a deferred tax liability for state tax purposes, then the opposite is true for federal. If I'm going to pay tax in the future for state, that means I have a future federal deduction coming. Okay? So it's easier to understand that way, but the reverse is true, meaning that in my example here, I've shown that I have a 20 of state DTA. And what that means is because the 35% opposite effect will always be true, that means that in the future, I'm not going to get a federal deduction of 20 that I would otherwise have if I just started with a simple example with no perms and temps. So there's something coming in the future, which is I'm going to get less of a deduction of 20 for state taxes than I would otherwise get. So I actually have two temps. Okay, and this guy is always going to be this number, right, with the sign flipped, because you'll always get the opposite effect, right? If there's a state savings, there'll be a federal detriment. If there's a state future liability, there'll be a federal benefit. Okay, they go opposite. I know that's confusing, and like I said, it's easier to think of, I think, with a situation where the state tax is a deferred liability. So if you want to do this example all again, you can. I'm not going to do it, but if you want to do it all again with depreciation instead of bad debts and make the 200 go the other way, maybe the example would click a little better. But we have net temporary differences for federal of 180, and 180 at 35% should be, let's see, 180 times 0.35 is going to be 63, right? So times 35%, and that is 63. So our total provision then is going to be the 409.5 and the 63, and that is 346.5. Okay. So our total provision, we have federal provision of 346.5 and a state provision of 110, and that is 456.5. So if I was thinking of a rate rec, I would start with PBT of 1,000 and expect a 350 provision, and we know that we got down to 456.5. So let's figure out what the differences are. So we have our state tax, which I will label as, let's say, I'll label that as a circle, and that's my 100. And then I've got my federal benefit of state. Oh no, whoops, I made a mistake there. So it's not 100, right? It's 110. I have a state tax provision of 110. So then I have my federal benefit of state. And remember that I said I should expect that to be 35% of this 110. So 35% of 110 is 38.5. And then the last thing that I have from a PERMS perspective is my meals and entertainment, which is $100 at 35%. And so that is 35. Okay? And that should add up perfectly to get you to the 456.5. Now, it might be obvious at this point, but when I do the rate reconciliation, you can see that this is just the federal effect, federal effect of meals and entertainment. And that's because the state effect of M&E is already built in to this 110, right? So to the extent I have state permanent items, the way I've presented it here is I've included that as part of my total state provision. And this M&E here is just a federal effect. Okay? So the key takeaway from this example, and I would strongly encourage you to play around with this and use some different facts, is this. Okay? That is, I know it just gets confusing for some people, but what we're doing here is we're saying that anytime that there is a state deferred, there will be a federal corresponding temporary difference as well. Okay? And this gets even more complicated when the state tax deduction is deducted on a lag method instead of on a current method. Okay, so what we've assumed right now is that these $130 of state taxes, that they can be deducted currently, but in some situations that state tax is deducted on a lag basis. And so what happens is that 130 is not a temp item, or sorry, not currently deductible for federal purposes, but it slips down into the deferred section and becomes a future deduction. So you can play around with that too if you want, and we can go through that in class. But this is enough for now. This is Fed benefit of state, and at least a reasonably simple example to help you start processing that. Okay, that's enough for this lecture.